All right. So these contemporary issues, what do we have here? We have number one, you can see here, cryptocurrency. We must understand what blockchain technology is. We have here cloud, they call it cloud funding, but it's supposed to be crowd funding, CROWD, crowd funding, digitization of financial transactions, big data project finance, Islamic finance, we have behavioral finance, and then we have derivatives, markets in developing countries. So the handout that I've just shared with you has got all these things. And today I want to start with reverse gear. I would want to start with derivatives markets in developing countries, because this is the one that students fear. Derivative markets in developing countries, derivative markets in developing countries. So I hereby reshare it again, and somebody can pick it, and kindly, if you don't mind, share this document on WhatsApp. Share this document on WhatsApp if you don't mind. Share it on WhatsApp. I hope now everybody is able to see I've reshared, but to make it like permanent, just pick it and help Mwalimu sharing this document on WhatsApp. Ladies and gentlemen, whenever we talk of contemporary issues, we are looking at modern, emerging areas in finance. There are many, many things that are happening around ourselves here, all right? Even, for example, as a country, for example, to manage the fuel rising prices, the government introduced what we call G2G. You must have heard the G2G. Yeah, government to government. I don't know whether it worked, yeah, but at least now we have seen our oil prices stabilizing. Could be because of so many reasons. Those are emerging issues you're talking about. If the government wants to borrow today, it doesn't have to borrow, for example, like just from locally here by raising treasury bills. No, they can go ahead and issue. They can go ahead and issue. They can go ahead and issue. They can go ahead and issue what we call a government bond, Eurobond. Yeah, they can issue a Eurobond. Just a minute. Again, I can see there are some guys who are not here. Eurobond, for example, these are new areas. We have, for example, what we call sukuk bonds. So sukuk bonds, these are Islamic bonds, right? Once in this case here, you hear the government talking about sukuk bonds. Those are the emerging avenues that the government can use to do what here to borrow. That the government can use to borrow. All right. Yeah, using in this case here Islamic, it's like this morning class, guys, many guys are not even in class. We shall overcome. All right. So then I'm looking at derivatives straight away, and I will read the handout that I've just shared with you great people. And when we talk of derivatives, is there somebody who knows what a derivative is? Anybody who knows what a derivative is? What is a derivative? Now from the word derive, yeah. So a derivative is a financial instrument. A derivative is a financial instrument that derives its value from some underlying asset. Derives its value from some underlying asset. So derivatives basically are embedded, right? They're like, in this case here, the blankets covering what here? Covering some asset or some liability that is quite risky, and you'd want to protect yourself against, you making losses. So any financial instrument that does not exist on its own, which in this case here gets its value from some asset or liability whose risk exposure you'd want to minimize, is what we call a derivative. I normally give you guys an example of these chips. I know you know chips. In town here, on average, ladies and gentlemen, you will get in this case here chips going for about 100 shillings. And the price of this packet of chips of 100 shillings, it has like that ever since, maybe 5 years. I remember during our times, we used to buy a packet of chips for 80 bob. I mean, you can see the price increase of this packet of chips in this case here is so low. Perhaps they reduce the quantities, but I mean, the price is ever constant. How do we get these chips? We get chips from potatoes. We get chips from what here? From potatoes here. And what do you know about price of potatoes? The price of potatoes here fluctuates a lot. The price of potatoes fluctuates a lot. There is a time, in this case, you'll get one sack of potatoes going for Kenya shillings 7,000. Other times you'll get a price of potatoes going for Kenya shillings 2,000. So as a hotelier in this Nairobi city would want to cover themselves. You don't want, in this case here, when potato prices are shooting up to 7,000, here you are making losses. What you do is to have that blanket covering the price of potatoes. So the blanket in this case here will be the derivative. So straight away you walk, for example, to Murang'a. Murang'a is where we have lots of potatoes, right? So you go to Murang'a and negotiate with a farmer. Tell this farmer that, you know what, I want you on your 100-acre piece of land, I want you to plant potatoes. And once you plant these potatoes, during harvesting, I will come and buy these potatoes from you. So you agree on a price in advance, say 3,000. So you draw what we call, like, for example, a forward contract. So if you draw a forward contract with this farmer, you are telling this farmer, agreeing with him in advance, that, you know what, when this particular time arrives, I will be able to come and pick these potatoes from you at Kenya shillings 3,000. You see, now you are certain about about the pricing. You'll be able to cover yourself against any price increases in the future, because during harvesting, when I go to this Murang'a farmer of mine, I will be able to get these potatoes at the price of 3,000 that we agreed in advance with him. He can't tell me now, you know, the market price is 7,000. Tell him, no, we agreed. We have a contract here. Now, please listen. This contract that you have drawn with this farmer, you can easily go to a derivatives market and sell it. You can easily go to a derivatives market and sell it. A derivatives market and sell it. All right. So this derivatives market, you will take this now paper, the contract that you have, not potatoes, the contract. This is now the hotelier Joshua selling, in this case here, to this contract to another hotelier B. All right. At the derivatives, like the Nairobi Stock Exchange market here in Nairobi. So of course somebody may, admire that document of mine, tells me, sell this document to me at maybe 300, maybe 400. Yeah, because I have already a privilege. I've been able to secure a customer who is willing to sell these potatoes for me at 3,000. I have a contract with me. I have, in this case, an asset with me. So this contract, if I sell it, 300, 400, you can see the price really of this contract, the contract paper that I'm selling at the stock exchange. It's like a share. The price that I'll be able to command will be dependent on the price of potatoes on the ground. So a derivative is any financial instrument that you have that ascertains its value, that derives its value from some underlying commodity, from some underlying asset or liability that you are covering yourself from the loss. So many times they ask about that definition, and very few students are able to do what here to answer. All right. All right. So I'm looking at, you can search there, derivatives, the last section, derivatives. You can just search for this word, derivatives, on your PDF document. But for today, you can just read my document. You can read this document of mine. Let's read this together. So derivatives and their markets in developing countries. Definition of derivatives. A derivative is a financial instrument whose value is derived from the value of an underlying asset. So if you are betting on some index, or on some index or what year or some rate or some rate. Right. So, ladies and gentlemen, we have to understand that a derivative is a financial instrument whose value is derived from the value of an underlying asset, index, or rate. These instruments are primarily used for hedging risks, speculating on price movements, or arbitrage what year opportunities. So you're saying that these derivatives are simply used for purposes of protection. To hedge, you know, a hedge is a fence. A hedge is a fence which you put around yourself so that in this case, the devourers cannot, in this case, come and eat you up. So a derivative, ladies and gentlemen, is any financial instrument that in this case here you put across for purpose of minimizing a risk. And it shall be able to do what? It shall be able to derive its value from some underlying asset. Now, somebody may ask, for example, Mwalimu, I happen to be a member of AAR Insurance. I'm in their medical scheme. So is this insurance policy, for example, a derivative? Because you're using it to hedge against some medical risks, all right? And if I become sick today, I can go to Nairobi Hospital and get treatment, and I'll not be worried like how many times I'm sleeping over there. Will it be a derivative? No. Remember, this particular derivative, yes, of course, there is something you are covering. This insurance is covering something. But remember, it must be a financial instrument. It must be something that you can walk somewhere and sell to somebody. So I cannot, for example, transfer my insurance policy to Joy at a fee. So even if this policy is covering myself against some risk, it doesn't qualify to be called a derivative because of that lack of transferability. You can't transfer it at some money. And the only thing you can do is to cancel your policy. You can't transfer it to someone else. Remember, financial instruments are normally transferable. Like shares are financial instruments. You can transfer them. You can sell them. You can sell them. And their price in this case is dependent on what year, laws of demand and supply. All right. Then we have here types of derivatives, ladies and gentlemen. We have forward contracts. A forward contract is a private agreement between two parties to buy or sell an asset at a future date for a price agreed upon today. Now listen, if for example today Trump was to promise Mwalimu here Kenya shillings 1 million, not Kenya shillings, but US dollars, 1 million in 6 months' time. Of course, I know Trump can't cheat me. So whether Trump will give me the money or not will be a non-issue. That will not be worrying me. But what will be making me turn around on my bed as I sleep at night will be the exchange rate, which will be prevailing at the time when I get this money. If the exchange rate by then will be 160 Kenya shillings to the dollar, then I'll get 160 million. If the exchange rate at that time will be 130, I will get 130 million. You can see there is a possibility of me losing a whole 30 million. So the question is, how do I prevent this kind of a loss happening to us? I'll just walk to Equity Bank, show Equity Bank that I've got these things that I sold to Trump the other day, and now I have in this case here, this receivable of 1 million. And I'm not able to sleep very well. Mr. James Mwangi, please give me some medicine here. The medicine you will prescribe to me is known as a forward agreement. So he'll tell me, Mwalimu, let's write something with you. Let's write something with you here. What do we write here? We write an agreement that come in June, end of June, Equity Bank will be able to buy from me the dollars at some rate, say 140 Kenya shillings in this case here to the dollar. So once we pen down, now we are making an agreement over something that will happen in the future. So it's forward thinking. It's a forward agreement here. It's a forward contract. So anytime we talk about a forward contract, we are looking at that agreement where we will be able to deliver some assets will be able to extinguish some liabilities in the future at some predefined rate, some predefined price, Just like, for example, the example that I gave you of the farmer in Moranga. All right. So we have here forward contracts. It's a private agreement between two parties to buy or sell an asset at a future date for a price agreed upon today. Example, a farmer agrees to sell their crop to a buyer at a set price in 6 months, regardless of the market price at that time. And ladies and gentlemen, we have future contracts. Future contracts have the same explanation with what here? With these forward contracts. The only difference that we have between futures and forward contracts, you can write them over some whatever amount. You can have a forward contract which is denominated, which has a denomination, for example, of 1,400,000, and even 80 shillings. Whenever we talk of futures, ladies and gentlemen, we shall be looking at things that are standardized, like the 1,000 Kenya shillings, standardized, 1,000 Kenya shillings, standardized. So they are normally standardized. These futures, ladies and gentlemen, unlike forward contracts that can accept any currency, futures can only be traded in US dollars. US dollars. Futures can only be traded in US dollars. All right. So they are standardized. They are dollar denominated, and the futures normally sell at some organized futures market. We have an organized futures market. You don't just sell futures anywhere. We sell them at futures market, and futures mostly they are securities, financial instruments which are traded in America. Futures exchange are normally, in most cases, they're found in America, and that's why we're saying that they are dollar denominated. All right. So futures contracts, standardized contracts, traded on exchanges to buy or sell an asset at a future date for a set price. Unlike forwards, they are highly regulated. Ladies and gentlemen. If you look at your past papers, they always ask us this question. Differences between forward and futures contracts. Always, they ask us that. You can see like April 2023, question 4A. They asked us to give them key differences between future contracts and the forward contracts. Always. Standardization, forwards are always done what here? Forwards are always, in this case here, or rather forward, futures are always standardized. Forwards in this case here can accommodate any number. You can see trading, futures have an organized exchange. Yeah, we have an organized futures market. Whereas in this case here, forward, of course, you have this handout, don't write anything. You already have this handout, you'll be able to make reference to it later. So forward contracts, these are just over the counter. I go to Equity Bank, just across the counter, we are able to agree. All right. Forward contracts, they are traded over the counter, meaning that they are negotiated directly between parties without the involvement of an exchange, often resulting in less transparency and a higher counterparty risk. Now, because futures are highly regulated, their counterparty risk, the risk that the other person may run away, all right, is normally reduced, is normally lower. So futures contract, the exchange acts, that market called as exchange, acts as the counterparty to both sides of the trade, which reduces counterparty risk because the exchange guarantees the performance of the contract through its clearing house. And then, of course, forward contracts, the risk of default or non-performance is borne by the two parties involved. Meaning if one party defaults, the other party faces the risk of losing the agreement's value. So it has a higher counterparty risk. Settlement and liquidity, ladies and gentlemen. Remember, we have just said what here? What have we said here? That future contracts are normally traded. They're normally traded on some organized markets. So you can trade them like every day. All right. And that is why futures are normally considered to be more liquid. When you have a future contract, it's like you have money. You can just dispose of it anytime. Forward contracts, because of the risk involved, it becomes quite illiquid. I mean, we'll be able to accept two gentlemen agreement here. A third party coming to buy from you can be crazy, all right? And again, we have the concept of what here? Futures are dollar denominated. Whereas in this case here, forward contracts can accommodate any type of currency. So if come April 2025, they ask you for differences between futures and forwards, you kindly give me just two differences that you'll never forget. Two differences between futures and forwards that you'll never forget. Two differences between futures and forward contracts that you guys will never forget from whatever we've discussed. Any two that you'll never forget. Please just type, because now it sticks in your mind. So in short, I'm giving you an opportunity to reflect. Any two differences that you will never forget. Futures are a blah blah, forwards are a blah blah. Yeah, futures are liquid while forwards are less liquid. I agree with that. And they're liquid because we have an organized futures exchange market. Yeah, in this case here, futures are highly regulated. We have a market for the same, right? Whereas in this case, the regulation over, in this case here, forward contracts, ladies and gentlemen, is not even there because it's an agreement between two people. Futures are standardized and dollar denominated. But please try to separate. Those are two very important pregnant points. Write them separately. Say futures are standardized. In this case, your forwards are not. Say that futures are dollar denominated, whereas in this case here, forward contracts can take up any currency. Thank you very much. So great. So now we are together. I'm so happy. Just two or three. In most cases, they'll ask for three differences. So once you have two, even if you miss on one. So remember, we don't allow students to record from their side. I'm recording from this side. Yeah, because I can see somebody is trying to make like that. So we record from this side and then we share with you the recording. I hope that is okay. All right. Ladies and gentlemen, I'll be able to go back to my handout. So I've been able to read futures. Now you guys are okay. So we have options. Options from the word optional. These are great contracts that I would want my students here to start doing more research on. An option means what? You're not a must. An option that I've got an option. So I've got an advantage that I have access. All right. I have the right. But this right does not obligate me. There's no obligation there. It's not a must. So whenever we talk of options, ladies and gentlemen, these are contracts. They're financial instruments that give the holder the right, but not the obligation to buy or sell an underlying asset at a predetermined price before a certain expiration date. So whenever you talk of an option, you're supposed to remember that an option gives the holder the right, but not an obligation, to buy or sell a specified quantity of an asset in the future at a predetermined price. So it gives me the right, but not an obligation. It's not a must. Like the farmer in Moranga, if we have an option with them, what will happen? So we have an option contract that I'll come and buy these potatoes from you at Kenya shillings 3,000 per bag. But remember, it's an option. So when it comes to the harvesting time, I, Joshua, will go straight away to Moranga market. First of all, I do a survey. If I realize there are farmers who are selling to me, who are willing to sell to me these potatoes for 1,000, do you think I'll go back to that farmer to buy those potatoes for 3,000? If it's an option that I've written down with this guy, remember, an option gives me the right, but I'm not under any obligation. There's no obligation. There is nothing like a must. And that is why, ladies and gentlemen, under options, you normally pay what we call a premium. You pay a premium upfront because of that right. You buy that right upfront. So you'll tell this farmer, you plant these potatoes for me. I'll buy them from you in June. All right. I don't know how long these potatoes take to grow, but I think 6 months is good enough. So in June. But once you mention the word option, if he knows that you can come and bolt out any time, he'll ask for a premium. Give me 100,000. So that should you run away? Should you run away? Then I'll be able to have something to cling on. Remember, for me, who has bought the right, I'm the one in this case who has the option. I have the option. I have the right, but not an obligation. You see, for the farmer, if I decide to buy from this farmer in future, he cannot run away. He has to sell to me. He has a contractual obligation. Myself, what I have is an option. I can run away from this particular what year a person quite easily. I gave you this example. I know some of you have attended my classes. You see, for example, when we get into courtship, that's a very good example of what we call what year options. There's nothing like a must. Anybody between us, either the girl or the boy, should you sense danger, you are free to bolt out anytime. And in this case, you are spouse to be can't take you to court because there is no obligation. There is no obligation. What we have is called what here an option. That is why you are never told to court with one person. You're supposed to court how many? How many people are you supposed to court on average? Remember, these are just general friendships. How many people are you supposed to court on average? You people talk to me. Not unless you're not hearing me. Yeah, like 3. I love that, James. You must be saved. I love that. Yeah. And then remember that these are just general what here? Friendships, yes. I'm so sure there must be somebody saying, Mwalimu, we can only quote what here? We can only quote one. What if you are served with character development? Yeah, because there is character development in these lives. Yeah. Remember, an option gives you what? You move to the next. So an option in this case, ladies and gentlemen, gives you the right. You have what we call alternatives. It's good to have alternatives. You quote again one, Isha. Then you start again. Isha, time may not be on your side. We shall overcome. We shall overcome. Debatable. I'm so sure this is a bad even topic to talk about here, but it helps me to reinforce the point home that it's all about options. Is all about alternatives. Options is all about alternatives. Richard is also saying one person accept and move on. Move on. Yeah, you shall never, ladies and gentlemen, let me advise you like an old man here. You should always thank your Lord for all doors, whether closed or what here, open. Whether closed or open, always thank your God throughout. Yeah, this door shuts. Tell God, hallelujah, amen. Thank you. There are good things ahead. There are good things ahead. In this case, there is a trouble that is being removed from your life. So bad example, but we shall overcome. All right. So whenever they talk of options like they have asked us, somebody should also be able to give me these questions from your past papers. You must be seeing these questions. What are options? All right. What are options here? All right. Then we have swaps. Whenever you hear of this word swaps, ladies and gentlemen, swaps means what that you are exchanging. You are exchanging. There is something being exchanged. There is something being exchanged. So for us here, swaps are agreements between two parties to exchange cash flows or financial instruments over a set period. Yeah, and this happens especially in a group of companies. So we have, for example, RCM America, RCM Kenya. Assuming we borrow a loan in Kenya here and we are RCM Kenya, but this loan is denominated in US dollars. Perhaps we want to buy something in US dollars. So we go to Stanbic, tell Stanbic, please give us a dollar denominated loan. So we are paying this loan. And then we realize, hey, now this dollar is becoming expensive. And our loan payment is becoming what here? The payment is becoming very expensive. We can easily talk to our parent. We tell our parent, this is our Stanbic bank. When it reaches this time, you be paying what here? You be paying this amount every month. Because you have guys in America have dollars, just pay dollars here. And then if in America, they also have a Kenya shilling, it could happen. They have a Kenya shilling denominated loan. Being that we are in one group, we can easily swap payments of some cash flows, right? We can swap, ladies and gentlemen, in this case here, interest obligations. One company could be having like a floating loan rate, a floating loan, which interest rate in this case here keeps on fluctuating. And then we have another one having a fixed loan, fixed rate loan. All right. So if, for example, we are like in two different countries, and then we realize that, hey, in this country, the person who has this floating loan, things are going better. And in the other country, the one who has got fixed, you can always swap. After all, you are a group of companies. This is your subsidiary. This is like one and the same thing. So whenever you hear of swaps, ladies and gentlemen, always think about what here a situation where related companies especially. You can also have unrelated companies, but in most cases, it's about related companies. It's about related companies. It's about related companies. Just a moment. You simply come and swap cash flows, which are denominated in different currencies. So you take obligations which are not you are helping a brother here, you are helping a sister there. All right. You can also interchange, in this case, your interest payment obligations here, simply because you want to take advantage of each other, each other agreements. So it doesn't matter whether you understand this or not. What is most important is you to pick keywords. Because I'm telling you, whenever it comes to theories in KASNEB, by the way, and I'm really sorry to tell you this, even this paper called AFM, when you get yourself, in this case here, getting a fail and a fail, please, sorry for using this again, bad example, know that in most cases you score yourself less than 10%, your own marks less than, because we really try to push you guys to get to the finishing line. So they get, like, at times we say, so long as they have written something that makes sense somehow. But if they have written and they've responded in a theory question, like instead of, at times they can even write a dog is a dog, right? Yeah. So long as you've written something, but most importantly, so long as it makes sense, we'll always give you all the marks, all the marks. And that is why you realize that students who are very, very confident, even if they've not attended classes, at times they tend to pass. What you need is general knowledge, and then time management. And then most importantly is that you must answer all theory questions. Like now, last semester, the theories were over 35% and easy theories. That is why whenever I'm teaching these theories, I want you to discuss how to discuss. And again, students lack exposure. You'll be getting some students here. You ask them, like now, the other day, the dollar was Kenya shilling 160. Now it is 129. Ask, in this case here, some students here, why do you think this dollar has reduced in value? Yeah. Yeah. Has reduced value. Or why is the Kenya shilling in this case here gaining value with time? I'm telling you, most students, you keep on complaining that KASNEB is bad, but most students can only give you one answer. And you can't blame them, because most of them, when it comes to news, they don't watch finance news. And even things are worse now with TikTok. The only thing that most guys are now watching are people dancing. All right. But we shall overcome. We shall overcome. That's why we need to sit down, even if it's over these lunch hours. We just discuss. We say it's theory, because you'll pass just by knowing these theories. AFM is not just about number crunching. It's not about sensitivity analysis. You are so good in no. AFM, you'll be surprised. If you know lots of theories, you'll easily pass. Are we together, ladies and gentlemen? Am I speaking some sense there or nonsense? At times you should also tell me, Mwalimu, now you are telling us nonsense. That's how free we are with my students here. You have to create time. You have to create time and get through this. All right. So swaps, so long as you mention the concept of agreements between two parties to do what? To exchange cash flows or any financial instruments over a set of time. Common types include interest rate swaps and currency swaps. You can even mention something like that. That would be very, very good. Now then we have examples of derivatives markets in Africa. In Kenya, we have introduced a derivatives market, but it's still at the infancy stage. It has not yet gotten its feet. Yeah, the ones that are very, very strong, I know, like Ethiopia Commodities Exchange is so big. Yeah, the coffee exchange in Ethiopia is so big. In Kenya, you know, Kenya, we are not a very, very strong country. We are not a very, very strong. It's only that God loves us as a country. But in terms of leadership, in terms of yourselves, even as accountants, we are not serious people, right? We know, for example, like these people are doing cash crops. For us to save them, most of them in this case here do not have money for inputs. There's so many things they need. If we just made sure that we have a strong coffee exchange derivatives market, we have even a milk derivatives market, and they should be very different, such that once a farmer even mutes or rather thinks of just coming up with a project, he can easily walk somewhere and say, hey, I'm selling this promise. Yeah, because derivatives is all about selling promises. I'm selling this contract to you. Come, we enter into some agreement. So derivatives will be able to open up partnership areas which will be able to do what here to help these farmers. I mean, farming is supposed to be quite a lucrative thing. But how things are being run in this country, all of us, we are just on top of what here, just vehicles, doing politics from day one to day last. All right. If you look at, for example, the coffee exchange in Ethiopia, because of people meeting at this coffee exchange to discuss, to even bring people from outside. Now it has even become a tourist attraction area. All right. You'll get people exchanging ideas, and that is why coffee in Ethiopia, coffee from Ethiopia is the best globally. Is the best globally. Yeah, wachana ikawa unakunywa kawa kidogo unasikia asidi na kuchoma. If you sit down in Ethiopia to drink coffee, you can do in this case here coffee in Ethiopia even 4 glasses without adding sugar. Hapa Kenya tuko na coffee gani? And it's simply because of what is this coffee exchange, the coffee exchanges, right? Where just people go there not to buy and sell coffee, no. To exchange contracts here, derivatives here. That on top of the coffee that they'll be able to make profits, somebody in this case will be able to draw an agreement and then they make what here? A profit out of that. So then we have a few exchanges here according to your syllabus, which you're supposed to discuss. We have like the Johannesburg Stock Exchange in South Africa, JSE, one of Africa's largest and most developed derivatives market. The JSE offers futures contracts, options, and commodity derivatives. Examples include, so you can see futures contracts, options, and commodity derivatives. Examples, you don't have to go to those examples. Those are useless. But in this case here, Johannesburg, you know, is known for gold. So they have very big gold exchange market. Then we have our great country here, which is really suffering for lack of dollars, the Nigerian Stock Exchange. The Nigerian futures market, you can see them, they have a futures market here, was launched to allow trading of agricultural and energy derivatives. It includes products such as soybean, maize, crude oil, and the currency derivatives. We have Mauritius, this country with a majority of its people being very, very happy. 90% of people from Mauritius, they're very, very happy. 90% of people from Kenya, they are unhappy. That's according to the UN Happiness Index. So this Mauritius Stock Exchange, Derivatives Exchange, introduced financial derivatives trading, including equity derivatives and interest rate derivatives. Then we have Kenya. Nairobi Securities Exchange has recently, I mean, nothing is happening there. I know they have employed people, but nothing is happening there. Yeah, there's a time I applied for senior position there. I mean, nothing is happening there. So Nairobi Securities Exchange has recently introduced derivatives at trading, including equity futures. This offers traders the opportunity to hedge risk related to stock price movements, etc. Benefits of derivatives. Why should we have derivatives in these developing countries? So we have risk management. They'll be able to give us market liquidity. How? Because when I have a contract, I can go and sell. So liquidity in the market. They'll be able to even enable us discover prices of our commodities. Yeah, because when I'm walking around in these futures, are trying to even sell my future, sell my forward contract here to people at the stock exchange, I'll be able to get people saying, hey, I mean, these potatoes are now going for this much. So you get in this case to discover the price, challenges, disadvantages. In this case here, we have what here, market maturity. Many African countries are really underdeveloped. They don't have derivative. If Kenya, we don't have a working derivatives market, do you think Tanzania will be having? No. So market maturity, we are still at our infancy stages. Regulation, of course, because we are still at the infancy stages, we will have weak regulatory frameworks. Liquidity, because the markets are not there, so we are talking of low liquidity in some markets, can result in a high cost of entering and exiting what your positions here. All right. All right. Yeah, they must be using dollars, yes. If the moment they call it futures, they must be using dollars there, and they have a problem with what here? With dollars there. They have a problem with dollars there. All right. So then, gentlemen, that is the end of this topic as per your course outline. Topic number what here? 9. There is a subtopic called derivatives. That's what you are supposed to know only. All right. But of course, later on, you'll be doing with the Mwalimu, you'll be doing in this case here, for example, these concepts of what here, foreign exchange. Yeah. You'll be doing a lot of mathematics. You'll be able to see, for example, if it's options, we have call options, put options. But for now, that is the end of the derivatives. There are so many questions there that I would want you to go and read later. You read later, very, very many questions that I would want you to go and read later. So like we have done this April 2023. I would want you to go and do December 2022, question number 5. You can see here, financial derivatives are widely used in financial risk management to hedge against various risks, such as market fluctuations, interest rate changes, or currency risks. However, there are several limitations. They ask us to give them the concept of what are limitations of using derivatives. They're quite complex. Counterparty risk, especially when you're dealing with what here, when you're dealing with forward contracts, counterparty risk. Yeah, there could be a liquidity risk. All right. Regulatory already, we have seen that. Market risks here. Question 3, they wanted us to define a currency swap. Very, very easy. Already you have that. Be able to read that. Yeah. Disadvantages of using futures contracts as financial what here? Instruments. Yeah. Disadvantages of using futures contracts. So you have a few questions here with answers that I would want you to go and read at your own time, at your own time, at your own time.